Let's take a long-term look at the markets. Here we are joined by Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, thanks very much indeed for joining us. We get caught up in day-to-day choppiness in the markets, but you say that there's consistencies that investors should pay attention to. Tell us what you mean by that.
Sure. Well, it's very tough to, as you know, Andrew, to predict the macro, and I think we're seeing an example right now where economists generally are too pessimistic. Stock market is telling a very different story, and that's why I'm very focused on kind of the behavioral side of investing, because I think there is a consistency to that, which is after bear markets like we saw in 2022, where the market dropped 25%. It creates a tremendous buying opportunity, but unfortunately people turn bearish after a bear market. And that's why bull markets are born on pessimism. And that's what we saw in 2023. People pulled out of the market, even the market rocketed. And then bull markets grow on skepticism, and that was 2024. And you have 2 years where the market's up 67%. So the third year, inevitably, what happens is now the rearview mirror is showing a bull market, and people turn more optimistic, and the returns in the third year tend to be more muted. And the third year is really from October of last year through to today. The returns are positive, but they're not nearly as strong as the first 2 years. So I don't see a change in what's going on in this bull market, other than, obviously the whole storyline of the macro is different.
So we had 2 great years for U.S. stocks. So there's a real risk, you think, that 2025 will be lackluster?
Yeah, well, at least until the fourth quarter. I think the other thing that's going on here, Andrew, is that the S&P is obviously heavily weighted towards the Mag 7, the hyperscalers, and they're spending lots and lots of money to roll out AI and data centers. And so their incremental return on invested capital is coming down because they haven't seen the return yet. And they're saying, Andrew, but don't worry, it will work. And it hasn't yet. I think it will. I wouldn't have bet against these guys, but we haven't seen that yet. And that's another reason for why I pause. But I think we could be going into a period like the late 90s where the productivity for America corporations really kick in, but not this year, later. And that's when you see, yes, we all remember the dot-com bust, but the late 90s, the market rallied over 100% on big improvements in profitability. I think that's still to come. It's just premature.
So you think investors are making a mistake if they move away from these big Mag 7 stocks because of this productivity boost that's coming?
Yes. I mean, it's your time frame. From now until 2026, it might look pretty smart, but I could see a scenario, Andrew, where you get to the end of this year, Europe has outperformed the U.S., the equated S&P's outperformed cap-weighted. Active management has worked over the index passive because they're structurally underweight the Mag 7, and everyone says, see, it's finally turning. And then what happens? The return on these big guys, they start to generate returns on this investment, and boom, the S&P cap-weighted takes off and outperforms everything again next year.
And that's the thing with this the stock market, isn't it? It moves up abruptly, and if you're not in, you miss that. One of the portfolios you run is the global concentrated. Now, we were just looking at your top 5 holdings there as of a couple of weeks ago. You do have NVIDIA in there, naturally. Netflix is a big holding. Couple of interesting ideas, though. You have Progressive, the big insurance company, and CRH, the big building materials company. So I guess you do get to make concentrated bets on a global range of companies here.
That's exactly right. So I'm a believer that concentration outperforms diversification, but I'm also a believer in focusing on non-correlated ideas. So yes, we have an AI idea, but how is that correlated to a European, aggregates investment or insurance? So can you build concentrated portfolios but not highly correlated to each other? That's our goal.
That's the thing, isn't it? Yeah, stocks tend to move very much in line with each other. Leave us with a final thought. Do you spend a lot of time worrying about U.S. interest rate policy?
Not really, because the truth is there's been a lot of projections, but interest rates are pretty much where they have been. I would worry if you saw, the 10-year shoot meaningfully above 5%, because that would, you'd start to see that hurting growth stocks, high multiple growth stocks. But we just haven't seen it yet. I think the storyline for this year, Andrew, is going to be the resilience of the U.S. economy in the face of, perceptions of a lot of bad news towards tariffs, et cetera. It just hasn't come to fruition. And, we got a very good CPI print this morning, and that's going to drive stock higher, at least temporarily.